Chapter 7. Will dividends beat the market? I believe non-dividend stocks aren't much more than baseball cards. They are worth what you can convince someone to pay for it. Mark Cuban. Before we entertain the idea of whether or not a portfolio of dividend growth stocks will beat the index or not, let's take a step back. Ask yourself this: what is the ultimate goal of your investment portfolio? If the S&P 500 index returns 15% next year and you only get 13%, will you feel like the year was a failure? If you collected $50,000 in dividend income last year, would you care what the S&P 500 did? Is beating the S&P 500 really your goal? If so, then dividend investing might not be for you. Maybe you should just put your money in an index fund and forget about it. If your goal is to meet your real-life spending needs, then stay tuned. If you're still with me, then you've decided you don't care too much about the S&P 500. Your goal is really to replace your paycheck one day with a stream of growing income. Whether you earn a 7% return or a 12% return is irrelevant as long as you can pay the bills each month and sleep well at night. Okay, I'm skirting around the original question here. Let's get to it. Can you beat the S&P 500 investing in dividend growth stocks? The answer is a resounding yes. It is possible to outperform the S&P 500 with a portfolio of high-quality dividend stocks. I've seen it done by individual investors and corporations alike. However, what about the research showing that mutual funds underperform index funds over the long term? It is true, the average mutual fund will underperform a simple S&P 500 index fund over a long period of time. If you are deciding between a mutual fund and an index fund, you should take the index 99 times out of 100. If a highly trained mutual fund manager can't beat the index, how is it possible for you and me to do better than them? It's a lot more likely than you think. By investing in individual stocks, you have several significant advantages over Wall Street's mutual fund managers. Number 1, no mutual fund fees. Whether you or your investment advisor puts your money in mutual funds, there is an additional cost of around 0.61% per year on average. You don't notice this fee because it comes out of the fund's earnings, but it is there. If you add an investment advisor on top of the fund costs, you're looking at a recurring fee of around 1.6% per year. That is on top of one-time sales loads that can be as high as 5.4% for stock funds and 3.8% for bond funds. And that doesn't even include commissions, account fees, or any other costs associated with mutual fund investing. By purchasing individual stocks yourself or through your advisor, you have a head start on the average person that invests in mutual funds. Number 2, direct ownership. When you own individual companies, you get to own the stocks directly in your investment account. When you own a mutual fund or index fund, on the other hand, you have no idea what's in your portfolio, and you certainly don't have control over what is bought or sold. Owning individual stocks also allows you to receive your income directly from the company. When you own an index fund or mutual fund, you don't own the underlying companies, you just own the vehicle that owns them. That means the fund has control over the dividends and when to distribute them. Individual stocks also mean that you will get paid more frequently. If you own a portfolio of 30 to 50 individual stocks, you will get paid somewhere between 120 and 200 dividends over the course of a year. Contrast that with most mutual funds who only distribute dividends once every 3 months. More frequent payments mean 2 things. 1, it's easier to pay your bills. If you're retired and living on your dividend income, would you prefer to get 4 paychecks per year or 200? The more checks, the better. And number 2, your money compounds faster. Receiving more frequent income allows you to reinvest the dividends faster. The faster your money compounds, the more it grows over time. The difference between monthly and quarterly compounding can be a big deal over time. 3, higher income. The average large-cap mutual fund offers a dividend yield somewhere in the neighborhood of 2% before fees are taken out. After the average mutual fund fee, most investors end up with a dividend yield of 1.4%. In some small-cap mutual funds, the end investor may not receive a dividend at all. Unfortunately, buying index funds doesn't offer much help. At the time of writing, the S&P 500 index offers a dividend yield of just 2.01%. Number 4. Own higher quality stocks. The primary argument for investing in index funds is diversification. The idea is to spread your money across as many different companies as possible. That way, if one goes under, you won't notice that much. This makes sense from a mathematical perspective, but not from a business perspective. Think about the companies in your hometown. Do you believe those businesses all make the same amount of money? Of course not. Some companies make money hand over fist, while others barely scrape by. Some have a loyal customer base, while others struggle to get people in the door. If given a choice between owning a little bit of all the businesses, both good and bad, or holding only the best, which would you choose? Of course, you would prefer to own more of the best businesses and less of the bad ones. If you would prefer to own only the best businesses in your hometown, why would you not prefer the same in your investment account? Higher quality companies that make more money will result in better investment returns over time. Research backs this up. High-quality dividend-paying companies tend to fall less in bad markets. During the Great Recession of 2008 and 9, the S&P 500 dropped by 37%, while the U.S. dividend achievers only declined in value by 26.5%. By investing in dividend stocks, you will be selecting from the highest quality stocks available. As we mentioned earlier, less than 10% of the available U.S. stocks have raised their dividend for 3 consecutive years. Less than 2% have increased them for 10 consecutive years. If you focus on dividend growers, you are automatically selecting from the top 0.8% of all stocks out there. Number 5. Dividend stocks outperform non-dividend paying stocks. Since 1972, companies that paid a dividend have dramatically outperformed those who have not. A $100 investment in a non-dividend payer would have lost money. Those who had paid a dividend but cut or eliminated it fared better, but not much, growing $100 to $264. The dividend payers who paid a dividend but did not increase it grew $100 to $2,199. The difference between paying a dividend and not paying a dividend was 10 times. However, it gets even better. Those companies that not only paid a dividend but increased it in that year grew a $100 investment to $5,997. Which would you rather invest in? Every single stock in the entire market, or a select few that consistently grow their income each year? Number 6. Think longer term. I feel sorry for mutual fund managers, not because they aren't paid enough, but their jobs are hard. The culture on Wall Street is to obsess over performance numbers. If a mutual fund underperforms its benchmark in any given year, even 3 months, investors move their money to a different fund. The manager could even be fired if that fund underperforms the benchmark for a few years in a row. This focus on short-term results forces mutual fund managers to make short-term decisions. The manager might make changes that hurt results over the next 20 years to make investors stick around. If you own a portfolio of individual stocks, you are free from the pressures of Wall Street. You don't need to answer to anyone about your performance over a 3-month period. That allows you to make decisions focused on the next 10 years rather than one. A long-term focus lets you ignore a company's short-term results. If a business misses Wall Street's expectations for its earnings, it could have its stock price crushed by 5% or more in a day. An earnings beat could drive that stock the other way in a matter of seconds. As a dividend investor, you aren't a slave to earnings reports or short-term fluctuations. Over time, these things will even out. Focusing on the dividend allows you to think about what drives stock prices over the long term, dividend growth. A 10% increase in the dividend indicates that management is confident that they can continue to pay that dividend indefinitely. If management were not confident in the future, they would not increase the dividend. That makes dividends a true indicator of a company's long-term outlook. Number 7. Minimal trading costs. Mutual funds and short-term investors, traders, are always buying and selling stocks. All this activity leads to high trading costs and lower returns. A long-term focus allows you to reduce trading costs to virtually nothing. Trading costs come in two forms. 1, commission charges from the brokerage firm, and 2, bid-ask spread costs. The commission charge is typically somewhere between $5 and $10 per trade. That doesn't sound like much, but it adds up over time. A mutual fund might make tens or hundreds of trades each day. This adds up to thousands of dollars in costs that are paid by who? You, of course. Another cost of trading is called the bid-ask spread. When you make a transaction on the stock market, there is always a small difference between what the buyer and the seller are willing to pay. This spread means that both the buyer and the seller take a cut off each trade. This cut is often just a few pennies. Over time, however, these pennies add up to big bucks. In a study of 1,758 mutual funds, research concluded that trading costs add up to an average of 1.44% per year for the average mutual fund investor. That is even more than what they pay in expense ratios and other fees. If you own individual dividend stocks, you'll pay a $5 or $10 commission when you or your advisor purchases the stock, but you may not pay another cent for another 5, 10, even 20 years. Over the same period, a mutual fund manager would rack up hundreds of thousands of dollars in commission costs. While the fund managers frantically click on their trading screens, you'll be cashing those dividend checks. Number 8, lower taxes. Mutual funds have no real incentive to watch out for your tax bill. Their performance numbers don't consider the tax implications of their regular trading and short-term gains. They only care about what return they get before taxes. That is the number that gets reported in all the investor brochures. As an investor, you don't care about the headline number. The only thing that counts for you is what your net return is after you pay all taxes and costs. On a 10% gain, you might see only 8% of that after tax. If you have a portfolio of individual stocks, you can be more strategic about when to buy and sell for tax purposes. That could save you between 10 and 15% on your taxes each year. You can also use what's called tax loss harvesting to offset gains with losses. Number 9, ignore Mr. Market. Let's consider a mutual fund manager that does a detailed analysis and decides that a stock is worth $100 per share. If the stock is trading at $50, the mutual fund manager would consider it a buy and add it to the fund. The problem is that Mr. Market doesn't always agree. If the company misses their next earnings numbers, Mr. Market may only offer $40 per share. If Mr. Market gets extremely pessimistic, he might push the stock down to $20. It's hard to stare Mr. Market down as he continues to rate your shares lower and lower in value. As a dividend investor, you can insulate yourself from Mr. Market's mood swings. If you buy shares in Coca-Cola at $40 per share, and Mr. Market reprices those shares to $35, you don't mind. You're still receiving $1.32 per share in dividend income each year. And that income continues to grow even if the stock price falls. Even if Mr. Market never prices Coca-Cola stock above $35, you continue collecting your dividend checks every year. Number 10, get 100% of your dividend income. When you invest in individual stocks, you are the direct shareholder in that company. That means you get all dividend income directly to your account. When Coca-Cola pays its 33-cent quarterly dividend, you receive that on the payday and not a day later. With a fund, those dividends first pass through a third-party investment company. So Coca-Cola's dividend checks go to the mutual fund first. Then they get distributed to the shareholders at the fund's discretion. Rather than receiving checks directly from the companies, you have to wait until the fund pays once every 3 months or so. Even if you do not beat the index. Let's assume for a moment that you can look into the future and see that your portfolio of dividend stocks will underperform the S&P 500. Even if that's the case, you may still earn a higher overall return than you would following the typical fund strategy. How is that possible? Let's say you're 40 years old, starting with a $250,000 portfolio. A traditional index fund strategy would have you put your age into a bond index and the rest into stocks. According to this rule of thumb, a 40-year-old would put 40% in bonds and 60% in stocks. Each year, the investor would reduce their allocation by 1% and move that into bonds, getting more conservative over time. Let's assume that the S&P 500 index returns 8% and the bond index returns 3%. The portfolio starting with 60% stocks and 40% bonds would grow by 5.7% per year. As a dividend investor, your 40-year-old self isn't interested in bonds. You want to grow your future dividend income so that it will eventually cover your expenses. Bonds are going to slow you down, so you go with 100% dividend stocks. Let's say your portfolio underperforms the S&P 500 by 1%, returning just 7% per year instead of 8%. That would be disappointing, but you would still achieve a higher realized return than the index investor. Why? Because the index investor owned bonds that only produced around 3% per year. So even though the return for their stocks were 8%, the returns of their overall portfolio was just 5.75%. That's still 1.25% lower than yours. One of the key advantages you have over a traditional indexing strategy is that a dividend investor has little need for bonds. We'll talk about that more in the next chapter. Over an extended period of time, it is possible to outperform the S&P 500. Will you or I beat the market over the next year or two? I don't know. What I do know is that you will have collected a ton of cash over that period, and that dividend income will continue to grow.